Good morning, everybody. This is the live market open, and today we have something different. We're going to have a short normal show and then have a detailed 2016 outlook. I'm Yohay Elam of Forex and Market Movers doing the show and the outlook today for FX Street. So let's do a quick roundup of what we had in markets, recent developments, charts, and what's next. In general, we had figures yesterday coming out. German unemployment was okay. But then eurozone inflation came out lower than expected, not lower after the German figures. UK construction PMI actually was better than expected, so not all figures were terrible yesterday, but it didn't help the pound too much. We'll talk about that soon. Milk prices did drop by 1.6%. That hurt the Kiwi, added insult to injury. Chinese services PMI missed with 50.2 points. That means that the services sector is not doing better than the manufacturing one. This also weighed on the Australian dollar. And the big news from tonight was political news added to the risk-off atmosphere. North Korea detonated a hydrogen bomb, an H-bomb. It announced it. It was felt in China, seen in China, South Korea, Japan, and this added worries. So in general, there's a more risk-off atmosphere. It didn't begin with the bomb, but it certainly was felt across markets. Okay, so let's look at the euro. Euro dollar yesterday extended its falls, reaching around 107. Now it's 107.30. Made some kind of recovery. The hydrogen bomb from North Korea is a risk-off event, and this helped the euro recover just a bit. But in general, higher chance of more ECB action because of low inflation. A stronger dollar in general. Weighed on euro dollar, sent it below support at 107.90, 108 level, which we talked about yesterday. Next support that I see is 106.30, which was actually the top of the pre-Draghi range. Resistance week one at 107.60, more significant 107.90. Okay, pound dollar continued falling. It's currently at 146.40, around the lows. Falling once again. Today we have the services PMI in the UK. This will give us a better indication of the economy. So far it's 1-1 between manufacturing and construction, but the pound is just extending its falls from 2015. A rate hike is not expected to come anytime soon to the UK. I would say 147 is some kind of resistance. 146.10 is support, but it's hard to see where the pair will stop at these kind of levels. You can see if we zoom out a bit, we have quite a fall over there. Dollar yen, of course, the yen is the classic, the clear safe haven currency, 118.70. You can see the fall related to the news from North Korea. Yesterday, the yen also strengthened against the dollar, while the dollar strengthened against anybody else. So the yen was the king. And this news from its neighbor, North Korea, strengthened the yen even more. It doesn't make sense when there's trouble in your neighborhood, but that's what happens with safe haven flows. Okay, money is repatriated to back home from riskier assets. Okay, dollar CAD, the sky's the limit. I think I said that many times, and now as we speak, it's reaching new highs, 140.60. 140 was some kind of resistance. It was reached late in 2014, just before Christmas. And yesterday we had a break higher. It's the strength of the US dollar, the risk-off atmosphere. And despite some news that the API inventories were actually showed a drawdown, it means less oil. And actually oil prices are they dropped a bit, but they're not at the lows, okay? Oil prices 35.60. They're of course lower. It's important to note that the Canadian dollar suffers from every fall in oil prices, and when oil prices do recover, it doesn't really respond positively. It's the market wants to sell the Canadian dollar. So we have the jobs figures from Canada on Friday. Also, the Australian dollar suffered, a risk currency. Bad news in Asia from North Korea. Slowdown in China with the services PMI. It dipped below 71 just before the show began. 71.50, I would say, is strong support. 70.60 is strong support. 71.50 is now resistance. We're back to a lower range. Aussie dollar has one of the best technical behaviors out there. Kiwi dollar, one of the most resilient currency pairs, 66.50. But how long can you stand on your own when the dollar is storming the board, when the Kiwi is a clear risk currency and we're now in risk off mode, and of course when milk prices fell? So we're back to the previous range of 66 to 67, bang in the middle, 66.50. More pressure on the Kiwi due to no more news this week, but the risk-off atmosphere is negative. Dollar Swiss, the Swiss franc used to be a safe haven currency many years ago, but now it suffers intervention from the Swiss National Bank, so it moves more in tandem with the euro, currently close to 101. But really, you should look at the euro. Euro Swiss, as always, around the 108 handle. 108.30 at the moment. 107.60 seems to be the line in the sand that the Swiss National Bank defends, at least for now, and maybe 109 is some kind of resistance. Let's talk about some crosses. Euro pound is dropped a bit because, well, the pound suffered a lot and the cross rallied, but afterwards we had some kind of, well, the euro did some catch up with the pound, so we're a bit lower. 73 support, 74.10 resistance. Euro yen, we're seeing how the yen is the king of safe haven currencies and the euro loses its safe haven appeal, extending the euro yen, extending its drops. 127.30. Where's the bottom? It's hard to see, but we're clearly breaking to lower ground. Okay, so the bottom, I would say, is at 126, which was the low back here, well, quite a long time ago in early 2015, in March, actually, when euro dollar was at the lows of the 12-year lows of 104.16. So we're getting close to those levels also in euro yen. Quite a fall out of higher ranges. And pound yen, well, 175 was support, and that's already past tense. Look at this extraordinary fall. How many days in a row? I think it fell, well, basically, it has a positive day once a week, and it's also only dead cat bounces. 173.70 is the current level. Fell below support at 175. Let's try to draw another line, but I think pound yen is one of the most suffering currency pairs. 172, I would say, is some kind of weak support, but currently there's this market route bad for risk currencies or even normal currencies like the pound, and good for the safe haven yen. Okay, we talked about that. Now, before we move to the outlook, let's look at the events for today. We have quite a busy day today. At 9:30 GMT, we have UK services PMI. At 1:15, we have the ADP non-farm payrolls. We're expecting to see another gain in jobs that will, first of all, the UK services PMI expected to be more of the same, drop from 55.9 to 55.6. This is the most important sector, the biggest one in the US. We have producer prices from Europe, but it's sort of second fiddle to consumer prices. ADP non-farm payrolls, expectations are for a slightly smaller gain, only 192,000 after 217. It could be even worse. And trade balance from the United States expected to be more of the same, deficit of 44 billion. Feeds into GDP, but less important for now for the NFP. For Canada, we also have some figures there. Imports, exports. Well, trade balance also in Canada. Any miss will be negative for CAD. Any beat will be ignored. That's how it seems at the moment. And then another big event for the United States. Well, three big events today in the United States. We have the market is low support, the ISM manufacturing PMI. Also here, like in the UK, the services sector is the most important one. We're expecting more of the same, 55.9 to 56, which reflects strong growth. 50 is the level between the limit between growth and contraction. So, and it's important to look at the employment component. Giving all the gloom we had recently and the weak ISM manufacturing PMI, also the non-manufacturing one, the services one, could also disappoint. I think we're in sort of tin hat mode. Markets are waiting to hear bad news. So I think if it just meets expectations, it should be okay. Factory orders are expected to drop after they rose last time 1.5. Now they're expected to drop 0.2. And the last but not least event for today is the Fed meeting minutes at 7 GMT. These are the meeting minutes from the historic Fed hike back in December. I think, of course, it's always important, but this is a document that is crafted very carefully, trying not to say anything. Meeting minutes have more impact when they're released for a meeting that did not have a press conference. This time in December, we had a rate hike, we had a statement, we had new forecasts, and we had the press conference. So it's a bit, the meeting minutes cannot reveal much more. The markets will be focusing on how many more rate hikes we'll have next year. And sorry, it's already this year, 2016. And this is sort of the last event for today. Will we have news from the meeting minutes? Maybe, but not as strong as in previous, not like in October, for instance, when we had the meeting minutes reveal that we're going to have a hike in December. I mean, they repeated it, made it clear, cemented it, okay? So, but the topic of how many hikes we'll have in December is relevant, of course, to the outlook that we're going to begin soon. And last, two more events to mention, less important, but crude oil inventories at 3:30. I jumped over that, important for the Canadian dollar. Perhaps this time we'll have a drawdown in inventories, positive for oil, but nothing is certain. And at midnight, Australian building approvals and trade balance, important for the Aussie. I think they'll show that the Australian economy is not doing as bad as the recent fall in the Australian dollar implies, because Australia is not only about China, okay? But I'll talk about that in the outlook as well. Okay, so we'll leave the questions for later, for after the outlook. Just last look at euro dollar. Euro dollar is still torn between being a safe haven currency and suffering from, well, weak figures in the eurozone that imply more ECB action. Okay, I'll take a small breath and let's do the 2016 outlook, okay? So again, thanks everybody for coming to the show. As we said, doing something different today, focusing on the 2016, all the time confused with the new date outlook. Let's begin. First of all, the agenda will begin, of course, with the biggest economy in the world, the United States. We'll talk about the Fed, the presidential elections, and oil. Then we'll talk about the euro, second largest zone. Is a change coming there? I have some optimism. Maybe it's unfounded, but let's see. And we'll talk about the pound nearby. And we'll talk about China. And talking about China has an impact also on other places, not only China, of course, not only Australia. Canadian dollar, also not only about oil. Japanese yen, what's going on there? We have some political events there as well. Australian dollar, of course, related to China, but not only. And the Kiwi. And if we'll have time at the end, also talk a bit about other places and other assets. Saudi Arabia, it's interesting also there. Brazil, Russia, stocks and bonds. Okay, but of course, the focus here on FX Street and Forex Crunch is about currencies. So the main agenda is currencies. Okay, and of course, we'll have time for your questions. So, Janet Yellen here, pictured here. You didn't expect me to be hawkish, did you? Well, she was relatively hawkish in the recent rate decision. The Fed did raise the rates, and they also talked about raising the rates 4 times in 2016, according to the dot plot. But let's do a small rewind. Okay, back to late 2014, when they had the same Fed forecasts, and they talked about having 3 hikes in 2015. Eventually, we had only 1. In general, the Fed tends to be optimistic. Have they calibrated their forecasts? Maybe. Currently, markets don't believe it. They're pricing in only 2 hikes in 2016, pricing in probably a hike in March and then maybe in September. They're not expecting the Fed to move too fast. Currently, the Fed is more hawkish, okay? That's, of course, the key for the US dollar. What the Fed does, the central bank, in most places, the central bank has the most impact on everybody, all right? So what I see for the US economy, for the Fed, is that we'll probably see, yes, we'll see more hikes, but it's not only positive for the US dollar. I think that the Fed and the US dollar will both start the year strong, like we had in the past few days. I believe this will continue in the first half, especially in the first quarter, but then it'll begin losing ground. Why? History tells us that each time the Fed began a tightening cycle, the dollar weakened afterwards. It's a buy the rumor, sell the fact. We're expecting the Fed to begin raising rates. It finally happens. The news is out. No more uncertainty, no more expectations. It's just playing out, and it can just take profit and reverse the moves. Now, we didn't see it yet. Why? Because this is not a normal tightening cycle. Everything is slower. GDP growth is slower. The drop in the unemployment rate is slower. Inflation is slower. And also the tightening cycle, as the Fed told us so many times, is very, very, very gradual. Eventually, this will come. I believe that we'll see it only in the second half of the year, and we'll continue seeing a stronger dollar in general in the first half, okay? Yeah, more considerations regarding growth. In the past 2 or 3 years, we had bad weather in Q1. It's normal, it's winter in the Northern Hemisphere, in the United States of America. And the Fed and also other economists blamed bad weather for weak growth, sometimes even non-existent growth. Sometimes we had contraction in the first quarter, a danger of recession. This time we have no excuses. We have this weather phenomenon called El Nino, which means different winds in the Pacific. We won't get into meteorology. We're talking about Forex forecasts, not weather forecasts. But anyway, we have relatively warmer weather in the United States. No excuses for slow growth, and we are going to see slow growth. So we are going to see probably more growth in Q1, but it remains fragile. The new normal or new mediocre, as the IMF said, of 2% growth is certainly on the cards in the United States. Better perhaps than Q1 last year and the previous one, but still nothing very impressive, okay? Once that we begin getting the figures, and they still aren't impressive because we don't have excuses, I believe that the Fed will be a bit more gradual in its forecasts and that the dollar could weaken, okay? The Fed could slow down on rate hikes, not raise rates 4 times this year, but still express confidence, still say that the US economy is doing well, that the economic growth is good, that the employment situation is good. Well, they do want to express confidence because it's a self-fulfilling prophecy, okay? If they're optimistic, it also really helps the economy because they have a lot of influence just because saying they're confident, okay? And they also not want to accept criticism. Many say that the Fed moved too fast and they'll have to undo what they did. They'll have to reverse the rate hikes. And believe that the Fed, at least in 2016, will reject any kind of criticism like that. So to conclude, again, probably a positive first half, what I see, and then a turn down later on, okay? What about oil? Oil has been a major topic. It has been relatively high and stable until mid-2014. It began falling. We thought it stabilized last year, and then it began another fall. In general, most people believe, including myself, that falling oil is a net positive for the US economy. Why did oil prices fall? Oil prices fell because the United States began producing more oil. The shale industry, fracking, all these new technologies, when prices were high, it created more oil. This tipped the balance, the global balance, and we have too much supply. Demand is not rising fast enough, so we had falling prices. Now, when oil prices fall, it's supposed to be good for the US economy. Why? because then Americans have more money in their pockets. Taxation on oil is very low, okay, in the United States, contrary to here in Europe. And every change in oil prices and global oil prices is immediately felt in the pump and in pockets. But where's that? Consumer spending in the United States, retail sales, that's still stuck. Where are the shoppers? American households are still deleveraging, still sort of licking the wounds from the financial crisis, still saving too much money and not spending. Another issue is that wages are not rising. Talking every month, we'll talk about it this Friday as well, and on Monday afterwards about wage growth. So we have more jobs in the United States, but where are the wages? We finally saw a small rise in wages, in sort of in the pace of wages back in October, but then again it slowed down in December. Let's see what happens now. In November. Now we'll have the report for December, and then of course during the year we'll have reports, and we're expecting to see it rise. So the high for 2015 was 2.5% year over year. It needs to rise to 3%. In order also for the US economy, for the US shoppers to benefit from lower oil prices, okay? And there are initial signs of improvement, as I said, but not that strong. The other side of falling oil prices is that, well, the reason for falling oil prices, I said, was producing the states in the United States, Nebraska, the Dakotas, Texas, that produce oil, okay? Also, so far, we haven't seen a big impact, a negative impact there, because if we have lower oil prices, we expect less production. Production so far in the United States remains high, 9.1 to 9.2 million barrels per day. But this cannot last forever, okay? And also, I had the chance to travel quite a bit in 2015, and buying airline tickets, they didn't really fall too much. And you expect flight tickets to fall, airline tickets to fall because of lower oil prices. That's because many airlines, not only airlines, hedged their oil prices when prices were high. This may change in 2016 when hedges on oil prices are long gone, and we'll have deflation coming from there, and perhaps it'll also hurt the oil industry too much. So we'll have to, in 2016, look at both impacts of oil prices. First, on US consumption, if it really rises, and that's of course good for the US economy and good for the world. And it may also lead to consumption of more oil because prices are low. And what's happening in the shale industry. We had very few bankruptcies. It's holding up pretty well, but it cannot last forever with oil prices that are so low for so long, okay? And now a more amusing topic for the US economy, the elections. An election cycle in the United States is very, very long. Candidates announce their candidacy about a year and a half or even more before the elections are held. Very long primary process that begins this month. So many debates, so many opinion polls. There's lots of money involved on the sidelines, of course. And elections happen in November, as always. It's a presidential year. We'll have lots of noise about that. But what I see is lots of noise and the minimal impact, okay? Of course, it's fascinating, and I'll be talking about this as well, but it shouldn't have such a big impact. Why? First of all, if we look at current opinion polls, and this may change, of course, soon, but we have in the Democratic Party, Hillary Clinton, a mainstream candidate, very known, a bit controversial, but basically mainstream, against Donald Trump in the Republican Party, which is a very, very peculiar character. Maybe he has some support in the Republican Party, but in the general American public, he's not that popular. If we have this kind of lineup, I think it's clear, that Clinton will win. That means less uncertainty. That means less impact of the elections, okay? In any case, Washington is stuck. We have a president currently from Obama, from the Democratic Party, Congress controlled by the Republicans. It's a mess anyway. The Federal Reserve has much more impact on currencies. But let's look at other scenarios. We need more uncertainty and less mainstream candidates to move things. So we have another small impact from election spending on opinion polls, on flyers, on TV ads. This could provide a small boost to the US economy, okay, but not really significant. Let's look at three scenarios. If Clinton, as I mentioned, as it seems now looks as a clear winner, I don't think will have an impact on markets because that will be priced in from a very early moment. Perhaps it's already priced in now, okay, 10 months before the elections. If we have two mainstream candidates battle, let's say Hillary Clinton against Ted Cruz or Marco Rubio, sort of more normal candidates, it can have impact in the fourth quarter because will have different policies, different opinion polls. It'll be very close, okay? Usually, I mean, it's quite rare to have a president from the same party continue for 3 terms. But, I mean, but if we have a chance that Trump can win, which is very, very unlikely, then we'll have huge volatility because that's a real unknown. Because his suggestions are, in my opinion, a bit ridiculous. And if we have a chance of him winning, that'll be, of course, crazy. We'll talk about that when time comes. Anyway, the story will accompany us throughout the year. But remember, the Federal Reserve is stronger than politics. Okay, now let's move to the eurozone. I believe that in the eurozone, it's darkest before dawn. So much trouble in the eurozone. We have we'll talk about that, political trouble. We have low inflation, danger of deflation, lots of action from the ECB that pushes the euro lower. We have really so much, such a huge fragmentation. The Greek crisis accompanied us. Everything looks bad in the eurozone. The euro had a terrible year. Euro dollar fell 9%. Yeah, it did recover because of Draghi's disappointment, but it's all in all, the euro is today at 107, 108. It was floating very steadily in 2013, 2014, 2012, around 130, 135. Okay, so it's much, much lower. Yeah, but I think it's darkest before dawn. First of all, we have some impact from the ECB's actions. Not all is lost. Not all is just throwing money at the problem without any results. We do have some results. Credit conditions in the eurozone are looser. It's easier to take a loan, to start a business, to buy a house. Specifically, I've seen it personally here in banks in Barcelona, and prices in Barcelona finally went up 9% year over year. But it's also this phenomenon of cheaper prices, looser credit conditions is seen everywhere. Finally, in the eurozone, we also have a lower unemployment rate. Okay, 10.7%, still very high, double than in the United States, but we already had much higher levels. The trend, at least, is looking more positive. Okay, we also have the best transition mechanism from the ECB is that we have a lower euro. Lower euro makes imports more expensive, higher inflation, which is the ECB's target, and a more attractive exports. This is Spanish wine, German cars, perhaps not Volkswagen, but quite a few others, and other products made here in the eurozone. And of course, the impact on the real economy is not immediate. It's not like the impact on our charts, but we are seeing it's lower euro for longer. It has a positive impact on the economy. Now, Mario Draghi did disappoint in December. Why? He created expectations that were too high and didn't meet them. Okay, but he still did a lot. Interest rate, negative deposit rate, it has been lowered from minus 0.20 to minus 0.30. Okay, so it pushes more money into the real economy and also out of the eurozone to weaken the euro. The ECB is still not done. Okay, it could act again in March, just a bit more, cutting the negative deposit rate once again, perhaps adding a bit more QE. The biggest disappointment was that they didn't act immediate QE. They didn't enlarge the monthly buys from 60 billion to a higher level of 70 or 80. They did extend the program from September 2016 to March 2017. They could extend it once again. and they did announce that they're reinvesting proceeds. That means they're maintaining a high balance sheet. It is meaningful. They could do a bit more. But what happens after March or after, I don't know, they might make another move maybe in April, maybe in June. I think they're done. Okay. First of all, the ECB has limited tools. It cannot cut the interest rate much lower. It cannot add too much QE. There's just not enough. There are not enough bonds to buy out there. It also has political limits from the Germans. In addition, they're going to get some positive news because the base effect on inflation is moving away. Inflation is measured, the eurozone focuses on year over year, and year over year prices rose. We saw that yesterday, only 0.2, and one of the main reasons is oil prices. Okay, once the effect of falling oil prices, which was mostly at the beginning of last year, in January, it reached the bottom before making another bottom now, but not the biggest falls are still behind us, or more than a year behind us. The base effect of oil and inflation is moving away. It can give the ECB some breathing space. And one thing that many people forget, trade balance, sort of the basics of foreign exchange, not only speculation, not only monetary policy convergence or divergence, but trade, okay? The eurozone, mostly thanks to Germany, has a trade surplus. That means that it exports more than it imports. That means that if there's no speculation, there's just more money coming in, okay? So in general, I think that once the ECB finishes its loosening, and that could come in a few months, and once we see that the Fed is sort of slowing down and not moving too fast, we could have the end of monetary policy divergence and the beginning of a recovery. But we'll talk about that. We'll talk about that soon. Technical problems. I see here a comment from Fabian. As far as I see, everything looks smooth, but hope everybody can hear me. We'll have questions at the end, so I wasn't expecting questions, but anyway, I'll keep on talking. I hope everything is working as expected. I do see the streaming. Anyway, I'll continue. This session is recorded anyway. So let's move from monetary policy to fiscal policy. We do have problems. Greece is heading for a new crisis. Why? Because the problems were never solved. They made an agreement that was never expected to succeed. Just another failure. Just another opportunity to blame Greece for not fulfilling its part. Huge primary surplus targets, which are impossible to reach, and just to scare off Podemos in Spain. That's how I see it. Speaking about Podemos in Spain and Catalonia, both here in Catalonia in early March, if there are no surprises, and perhaps also in Spain in February or March, we might have new elections. We had elections in late 2015 here in Catalonia in September, and just on December 20th in Spain. Both resulted in hung parliaments. The question of secession in Catalonia is open, and the Spanish economy isn't doing so well, despite other reports. The Spanish population has a lot to say. Anyway, we have troubles also here. Italy is rebelling against Brussels, sort of not accepting the dictate about the budget. France is seeing the rise of the far right, especially amid the entry of migrants, and of course the terror attacks on November 13th in Paris. And even in Germany, not all is great. Okay, so we have the German economy officially doing well, but in East Germany, the gaps between the East and the West are significant. Okay, so all in all, we do have some discontent. That's why I believe that we might see in 2016, maybe this is a bold forecast, but I think that we'll have a peak in austerity, an end of austerity, or at least less austerity. That harsh austerity has peaked, is already going downhill. And Germany will be spending on refugees. Merkel set no limit to accepting refugees. France already used the security spending as an excuse to spend more. Okay, another thing I'm watching, I don't know if it'll have a big impact on 2016, but Maybe so. Yanis Varoufakis, the ex-finance minister of Greece, very outspoken, very colorful, attracts lots of media. I've seen him here in Barcelona in October. He's launching a new party on February 9th, and he's talking also about a pan-European movement and more to come. If we do have, as I think, less austerity, perhaps not a 180 degrees shift, but a small shift, we can have more growth together with the impact of the ECB's policy. Okay, so I believe it'll be also positive for the eurozone. So I'm optimistic on the success of monetary policy, unless fiscal austerity. And for the euro, I think that the euro-dollar monetary policy divergence with the United States will shift. Not now, not today, not in 3 months, maybe not in 4, 5, or 6, but towards the latter part of the year. Okay, so this is my forecast. It's not trading advice. I think we'll have a V-shaped year for euro-dollar, a small drop and then a bigger rise. More suffering in the first half, perhaps a drop under the March 2015 low of 104.60, and then a virtuous rise to 120 or even 125. Let's see if I'm right or wrong at the end of the year. I think it's going to be a bit different. Monetary policy divergence does not last forever. Okay. Yeah, I'm continuing to the pound, very related to the eurozone. We had in the past, not so distant past, strong growth in the UK, but now I believe the thrill is gone. Wages are flattening, as the Bank of England said. Growth is slower than we had beforehand. And the Bank of England is hesitant about hiking. I was talking many times also in this show that the Bank of England is set to raise rates immediately or soon after the Fed. I think now I changed my mind. I see there's a big gap. Markets are pricing in a hike from the Bank of England only in 2017. It might still come in 2016 if things improve, but there's a clear lag between the pound, between what's going on in the UK and the United States. In addition, we have a risk in the United Kingdom of this EU referendum. There's no set date, but David Cameron and the British Prime Minister will probably hold a referendum in 2016 to get rid of this promise he made a few years ago and not push it into 2017 and have more risks. Of course, he wants to stay in. It's better for the business community, which donate to his party. I think most Brits do want to stay in for various reasons. So we have uncertainty from that and uncertainty from the eurozone, the main trading partner of the UK. Also here, I believe we'll have a sort of a V shape also here in pound dollar. Once the referendum is over, once we have, I believe, a small majority, like in Scotland, to stay in the European Union, things could get better. No more uncertainty, no changes. Also, the eurozone, as I believe, will improve later in the year, so things could get better in the second half. Assuming the Fed continues hiking and the world doesn't collapse, we'll have the Bank of England later in the year talking more about imminent action, about raising rates, and that could strengthen the pound. So I believe we'll have more pressure on the pound. We haven't seen the bottom yet in pound dollar. We're at the 146 handle at the moment. I think we can move a bit lower, but not much lower, not to the post-crisis low of 135, and then we could have a rise back up, okay? Not as virtuous as I see it for the euro, but I do see a recovery over there, okay? Let's move on to the Canadian dollar and then to China. Canadian dollar, I don't know how many of you are trading it, but at least on Forex Crunch, I have live readers interested in that. And it had, what dollar CAD rose 18% in 2015, and 2016 is seeing another rise for dollar CAD. So we're seeing a weaker, but not all is bad in Canada. Why? First of all, as I said about the eurozone, a long period of a weaker Canadian dollar is good for the economy. Not all the economy is about oil, okay? So Canada and the United States share a very long border and lots of trade, lots of US demand fuels the Canadian economy. So if we have a more favorable exchange rate, we have more US demand for cheap Canadian goods, okay? This auto industry and other places as well. Employment situation, another good thing. Employment situation in Canada is also positive, okay? At least for now. The bad things in Canada, well, oil. And the Bank of Canada, Stephen Pelosi, opened the door to cutting the interest rate down to minus 0.5%. Okay, currently it's at plus 0.5. We thought the lower limit that Mark Carney, Canadian, currently the governor of the BOE, said it would fall to. His lower limit was 0.25, and of course zero has been seen as the lower limit. But the Bank of England, the Bank of Canada is ready to go negative. Okay, the ugly and the unknown a bit about the Canadian economy is the housing bubbles in the beautiful city here of Vancouver in the picture above, and also in Toronto, the biggest city in Canada. So my verdict forecast for the Canadian dollar is that dollar CAD can continue higher, and for CAD this could be an L. It could be a bigger fall. It means 150 or 155 for dollar CAD, and then stable. Not a recovery for the Canadian dollar, but at least the bleeding could stop later in the year, assuming that the US dollar stops rising. Then the Canadian dollar could catch some breath. Okay, let's now move to China, the world's second largest economy. For a few years, it's trying to make this kind of landing. It's trying to transition from investment in manufacturing to being the sort of factory of the world and building infrastructure to more services and consumption. Services, of course, India is now experiencing a boom, growing faster than China because it's exporting services, going in the path of the West. And they're looking more to internal consumption. Okay, there's wages are rising, there's bigger middle class in China, and looking to more consumption. But it's a very, very long road. Another factor taken into consideration, there's going to be more uncertainty about China. Why? Nobody really believes the Chinese GDP figures that they publish very early every quarter, and they seem to be made up of thin air. But there were other measures to know how fast the economy is growing or how slow, looking at electricity, at rail cargo, at imports and exports, things like that. But if it's services that consume less electricity and no cargo, it's much harder to measure. So we're going to have more uncertainty. I would look at the Chinese Yuan, also known as the RMB, the renminbi, and pollution. Okay, if we have less pollution in Beijing, something the authorities are very sensitive about, it also means that there's less manufacturing. And for the and I'll explain about the Chinese Yuan. A weaker Chinese Yuan, which we are seeing in recent days, a lower value for the Yuan against the dollar, and it reflects to a weaker value against the rivals in Asia, the Japanese, and against the euro. That a weaker Yuan means that transition from manufacturing to services is not going so well. It means that China is still dependent on manufacturing. But it's not exactly what China wants, because then there's danger of faster outflows, not only from the stock market, which is relatively small in comparison to Western countries, but also out of further investments. So they would prefer a more stable yuan. It also means trouble for the Australian dollar and Japan. For the Australian dollar, it means, for the Australian economy, it means sort of that China is still in trouble. And for Japan, it means that there is more competition. If we do have a stronger yuan, then it's better for China and for the whole world. It means that transition is going well. Okay. Now, yeah, let's move to Japan, from China to Japan. The Bank of Japan is sensitive to the yen against the dollar. Each time the yen strengthens too much, the Bank of Japan and also the government, they open their mouth and begin complaining. And of course, it raises the chances of them intervening. They would not like to intervene. They would like others to do their work for them, I guess, like everybody, right? In 2016, I believe they'll be perhaps a bit less focused on dollar yen and a bit more focused on their rivals in Asia against the Chinese yuan, especially with recent movements. Again, they don't want to act, they want others to do their work. I think that the range between 115 and 125 that we've seen in 2015 is their preferred range for the Bank of Japan. They don't want the yen to weaken too much. It'll make imports too expensive, and it'll make everything unstable. We had a big weakening in the yuan, and now things are sort of in the right range. But if dollar yen falls under 115, it could trigger action, at least verbal action. Okay. Yet again, they prefer to talk and not to act. Also note lower oil prices. If oil prices continue staying at lower levels, it can allow for a lower yen because Japan relies on imports of energy, imports of oil. But I think they'll be more sensitive to the exchange rate against the dollar and against the yuan. More considerations to look out for in Japan. In 2016, here's a picture of the guy who's sitting is Kuroda, the Bank of Japan's governor, and the guy standing up is Shinzo Abe, the prime minister. The government is expected to raise the sales tax once again. Officially, I don't think it'll happen because they had a sort of big blow from raising the tax rate back in 2014. It pushed Japan into recession. We have elections probably to the upper house of parliament in July, probably. There's no set date, but it's expected that Shinzo Abe, the prime minister, the LDP party, will maintain the majority also in the upper house. If they reach a two-thirds majority, they could also change the constitution, but constitutional changes could happen only in 2017, and we don't know the impact. So this political event in Japan, I believe, will not impact the yen too much. Okay, let's move to the Australian dollar from also staying in Asia Pacific. The Australian economy is holding up relatively well. The employment situation looks really good. It seems that Australia is getting over China, less dependent on China, but the Australian dollar is still impacted a lot from China, even if the economy is less sensitive. Lower Aussie dollar for longer that we had in 2015 is supporting the economy, like the Canadian dollar for Canada and like the euro in the eurozone. And I believe that China will not let itself collapse. The demand from China to Australian commodities will still remain pretty healthy. Not huge growth, nothing spectacular, but good enough. But we have to look at commodity prices. They're not going anywhere fast. They're still falling. And the RBA has more room to cut. So the interest rate has stabilized at 2%, but 2% is above zero. We still have room to cut. Not in the next few months, but perhaps later on if things get worse. And this threat of RBA action is also sort of could have an impact. Also in Australia, another thing to watch out for is here we have a nice picture of the Sydney Harbour. Prices also, like in Canada, prices in Sydney and also the prices of homes may be too high. Okay, but if the RBA does macroprudential policy, that means limiting loans for mortgages, it could be a substitute for rate moves. Okay, if we have sort of the RBA tackling house prices with loan limits, it means less rate hikes. Less rate cut. That means they don't have to raise the rates, right? To fight house prices, that means they can let the Australian dollar down. So we should watch out for regulatory action also there. We had some of this in 2015, and we could have more in 2016. Of course, Chinese demand is also important for the Australian economy. And another sort of factor, if you want to look for correlation, it's still the price of copper. So the Australian economy is less dependent on China and commodities than it used to be. But for the Australian dollar, not only for the economy, commodity prices have a big impact. I foresee a turbulent year for the Aussie dollar, but I can't point out a clear direction at the moment. We have sort of mixed signs over there. Currently, the Australian dollar is tumbling down because of this risk-off atmosphere, because of worries about China. I believe the worries and the moves are a bit exaggerated, but it doesn't mean a rise in the Aussie dollar. I think it's going to be mixed. Kiwi, less dependency on food. Sorry, they're dependent still on food, and I think it's positive. Here we have a picture of some cows in New Zealand. Really beautiful landscapes over there. The RBNZ recently, the Reserve Bank in New Zealand, said they're sort of not expected to cut rates once again because they reached sort of the lower limit, 2.5%. The economy in general is doing well, not only because of milk prices, even though they fell yesterday, they remain a good source, milk, dairy products, good source for the economy. They did manage to, at least for now, contain excessive house price rises in Auckland, and unemployment is low. I think they'll have, the Kiwi dollar could have a positive year, especially against the Australian dollar. And let's see how that turns out. In the first half of 2016, I believe Kiwi dollar will depend more on the US dollar. In the second half, the RBNZ could act if the situation in the global economy worsens. We could have, and the Kiwi strengthens too much, we could have the RBNZ cutting rates to weaken the Kiwi dollar and to mitigate slowdown. But all in all, I do see a stronger Kiwi dollar in 2016, but this could be limited. We could reach this glass ceiling pictured below. Okay, so that's for the Kiwi. Don't know how many of you are trading it. I focused more, of course, on the US dollar and the euro more than currencies like the Kiwi. Okay, we have a few more minutes. Let's run fast on other events. I think Saudi Arabia is already a big story in 2016 with this clash with Iran, and it'll continue being a story throughout the year. Saudi Arabia, the huge oil exporter and producer, is in trouble due to low oil prices for too long, an oppressive regime. I think it's worse than Iran, for example, that is sort of the enemy. They're embroiled in a war in Yemen, their southern neighbor, with all the insurgency over there. And with ISIS. Some blame the Saudi regime for some collaboration with ISIS. Anyway, they're also in trouble because of the war in Syria. They now have less friends in the US. US and Saudi Arabia are long-time allies, but with less dependency of the US on Saudi Arabia, and with a more oppressive regime and more criticism, they're sort of have less friends in the United States and less friends in OPEC. We've seen how in late 2014, Saudi Arabia decided on its own to keep on producing high amounts of oil and angered OPEC members. So lots of trouble for Saudi Arabia. The Saudi Riyal, the currency there, it's pegged to the US dollar, and it's in danger as well. And that means because of low oil prices, maybe they'll have to devalue the Saudi Riyal to have more income in US dollars to support their spending, okay? And this could, of course, also create more turbulence. A weaker Saudi Arabia, I don't see a collapse of the regime, but who knows? But a weaker Saudi Arabia has implications for the whole Middle East. It could steer more turbulence. If we have clashes in the Middle East in general, and we've seen this tension now with Iran, it could push oil prices higher. Perhaps this recent crisis with Iran is helpful for both countries and other oil producers to lift oil prices. But in general, it's not good if we have trouble in the Middle East. It could have ramifications elsewhere. We've seen how the crisis in Syria has implications for Europe in terms of refugees and other impacts. So that's something to watch out for. Russia, similar to Saudi Arabia, colder weather, but trouble due to low oil prices for too long, oppressive regime, interventions in Syria, recently and beforehand in the Ukraine. And the world cares a bit less about Russia than it did last year, because we at the West have a very weak attention span, and no news from Ukraine is no news, even though the Russians are still there. But in Russia, we have high inflation because of the weak ruble. Discontent, it's still brewing there because of a worsening economic situation, a recession, and low oil prices. It could lead Putin, in the picture here, to more adventures in the Middle East, and that could be a risk for oil. So that's another factor to watch out for. Russia is not a big economy, but it has a lot of political weight. Okay, and quickly let's talk about bonds and stocks. Bonds first and foremost depend on the Fed. More Fed hikes, lower value of bonds, higher yields. Okay, yields could continue rising initially with higher inflation, with the base effects moving away, and with the hikes, but then it could drop back down. Stocks depend a lot on QE. That means I see a better future for stocks in 2016 in the eurozone because of more printing, and less so in the US. Company profits are relatively high in the United States, but lots of these profits come from stock buybacks, all kinds of financial engineering, tax avoidance, things like that. I'm making a huge generalizations, of course, not, but they'll have to produce more stuff, manufacture more stuff, and not only make buybacks. So I don't think we'll have this Wall Street panic here in the picture from 1929. But I also don't know. I can't see, unless we have more QE. It's hard to see, more. I think central banks. A lot still depends on central banks, and if the Fed really continues hiking, and companies don't make profits from selling stuff, I believe stock markets could fall, which is good for the Japanese yen as a safe haven, and a bit more for the euro and the dollar, but it depends on the timing. So that's sort of very, very brief note on bonds and stocks. Okay, I've talked for a long time and covered a lot of topics, and now it's time for your questions. Remember, ask anything. If we don't have time for it today, I'll be here tomorrow with the normal morning show as always, and also on Friday, and also next week. And this is recorded, so you can ask questions now and at any other time. Okay, because I talked a lot more than I had expected, covered lots of stuff. Okay, I see that the refreshing issues have been solved. A comment here: building a bridge from Tunisia to Sicily for adding migrants. They don't drown. 260. I didn't hear about that bridge, but anyway, the story of migrants, refugees in Europe, which has an impact, which could have a positive impact on the economy because of more spending and of austerity, and also could brew political trouble. It's of course interesting to follow in 2016. Baltic Dry Index and copper futures and China Global Indicator. Yeah, there are more things to cover, but I didn't reach them. Of course, Baltic Dry Index is just going down. Less trade in the world. Too many big ships and not enough people buying from other countries. No, you're most welcome. Hope you enjoyed the session. Do you can expect good news out of America today? Yeah, okay, moving back from the presentation for 2016 to today's events. Good news from America today regarding jobs, ADP, NFP. I expect good news. Expectations are for 192,000, and I believe we'll have something around those numbers, supporting positive non-farm payrolls on Friday. But with the ISM non-manufacturing PMI, I think expectations are a bit too high. We've seen the ISM manufacturing PMI fall, And we could also see the non-manufacturing PMI fall. Look for the employment component in the ISM non-manufacturing PMI. Regarding the Fed minutes, I think they'll try not to rock the boat. So these are the three events for today. I believe one positive, one negative, and one neutral. Any questions about 2016? Comment here about PMI just came out positive today for euro, though euro dollar is going down. It has less of an impact. First of all, markets look more to the manufacturing PMIs. Secondly, these are final numbers for France, Germany, and the eurozone. We already had preliminary numbers 2 weeks ago. So it's fresh news for Spain and Italy, but not fresh news for Germany and France. And there are bigger things in play. For instance, the weak inflation numbers that we had yesterday and the day before from Germany. And this impacts the ECB policy. So it's more important than final services PMI today. Hope this answers your question. Let's see if you have any more questions. Actually, we're pushing through our time limits today. I thank Mauricio and Adinda from FX Street for all their patience. Yeah, Jax asks what to watch today. So watch out for all these three events I mentioned in the United States. We have the focus shifting back to the United States. Just after the show, we have the services PMI from the UK. It's the most important PMI. Also watch out for the crude oil inventories if you're trading the Canadian dollar. But I think the focus is on US events more than anything else today. Tomorrow we'll have a pause from US events, and Friday, of course, non-farm payrolls. You're still sending out your quarterly report, predictable currencies, to trade later this week. Yes, I hope it'll be later this week and not early next week. I've had a lot of changes on Forex Crunch with the new design and preparing this presentation and other stuff. So I have a list of excuses for not sending it out yet, but it is high on my agenda. So yeah, the most predictable currencies. And the quarterly reports, maybe later on, it just takes more time to compile, easier to make a presentation and talk like we did today. And this presentation will be available online later today. I mean, a recording of what you heard now. You can also go to Market Movers Podcast. My associate Lior Cohen and myself talk about addresses here, but you can also search for Market Movers Podcast. My associate Lior Cohen and myself also made a 2016 presentation, which is only audio, of course, podcast format. Hi, for technical problems, I couldn't see it live. I'll watch the recorded video. Well, thanks. Do you have a written transcript or an article with the analysis for 2016? No, I have the podcast and the podcast notes. I have the slide notes, which I can share, and this recording also. But as we had already 2 comments from Ryan and from Fabian regarding a written report, I'll try to make an effort and just have it all written down and send it out as well, either by either to the subscribers of Forex Crunch or as a very, very, very long article. Let's see, I'll try to figure that out. Okay, I'm very happy for the positive feedback. Anyways, as Adinda wrote here, it will be published on FX3 today. Okay, it's already 9:05 GMT, and 9:05 GMT, 10:05 here in Barcelona. It's been a very, very long session, more than I had expected. We didn't have many questions, I remember. So we'll say goodbye for today, but you're welcome to ask any questions about the presentation or anything else in the other morning shows. We'll be here tomorrow as usual at 8 GMT, also on Friday, also next week. Thank you very much for the very kind words. Anyway, I wish everybody, again, a safe and successful trading day today. Lots of news today. A very safe and successful 2016. Busy year. Remember, these are my forecasts and things to look out for. I may be right, I may be wrong. If you remember, in December, I was right on one rate decision and wrong on the other one. Anyway, thank you very much for the kind words, everybody. And that's it for today. So good luck, everybody. Thank you, and bye-bye.